Welcome back. There we have it. That much anticipated budget has been tabled. And joining me to unpack it in greater detail is Mamello Matikinca-Ngwenya, Chief Economist at FNB, Maarten Ackerman, Chief Economist at Citadel, and Peter Attard-Montalto from Intellidex. All right, I'm keen to get your thoughts on that. I think maybe better than expected, Mamello?
So I think it depends on which lens you use to sort of analyze the budget. So we had spoken at the beginning about the government potentially using JAFECRA to lower the debt burden. So they are tapping into 150 billion over the medium the MTurf, and this obviously is they're aiming to lower the borrowing requirement and reduce the interest payments. So that's a positive, and I think in the short term the market will receive that as a positive. However, the savings that they're going to get are going to be used to increase spending on wages and social grants, which, in my opinion, is not positive over the long term. So it's becoming increasingly clear that the government really has a difficulty with reducing recurrent expenditure. And ultimately, the areas that they've selected to utilize the money or to enhancing areas, in that they are allocated to wages. And I guess the other positive really is that there's been money that has been allocated to infrastructure. They have increased the threshold for renewable energy projects, which should crowd in private sector participation, which should be positive for growth over time. And they've also made allocations to encourage, I guess, the production of electric vehicles. So I guess those announcements are quite positive, and in the short term, a positive budget. I'm just not really convinced that over the long term, it gets us to where we need to be.
Peter, I'd like to get your thoughts on that. I think Mamello also, highlighting the fact that it's clear that we are in survival mode of sorts. Therefore, we can't plan for the long term.
So, yeah, I think the problem with this budget, fundamentally, like with the MTBPS, is Treasury is giving us a very positive view, which we almost struggle to accept, right? There is always historically so much slippage, but we've actually seen them revise up revenues, which I think actually is appropriate. They're even a little bit low, even in a very weak growth environment. This is what we have to reinforce. But it's really the expenditure side and being able to realize these expenditure cuts and reallocations that there is just gnawing uncertainty, I think, in the back of our minds. But Treasury is clearly happy here. Remember, they send letters now out to departments, to provinces, to municipalities. They're locking in this level of expenditure. And so I think this is the readjustment that has to happen, even for us. And we were more positive, as I was in the preview. We still, I think, need to think about where this pathway goes. They're showing quite a sharp turnaround in debt to GDP, which should mean the bond curves flatten if they do realize that. I think the market reaction today shows the market trying to mull that through and the probabilities of that happening.
I must also ask you about, the growth forecast that we're seeing come out of National Treasury. Government is often more optimistic than the rest of us. They've said 0.6% for 2023, and I guess that's worse than what I thought, and I think many thought. But we're looking at 1.3% in 2024, and all of that is a contingent on Eskom and Transnet. It sounds like it's the same script, different year, Mamello.
So the 0.6%, you must remember, is the 2023 forecast. So they have some data that would inform that 0.6%, which is not significantly different from what we are anticipating. The 1.3% and a gradual improvement to 1.6%, I would say realistic in the sense that it is also, I think, not too far from how we're looking at the economy. We do not expect, this is before today's information, we had not anticipated a significant improvement in consumer activity, given that the cost of living pressures continue. Yes, inflation will decline over this MTurf. Monetary policy should become somewhat accommodative, but the labor market is still quite weak. So participation from a consumer point of view should be limited in relation to the positive contribution that it's had historically. The point was made right at the beginning of the preview around very weak business confidence. And obviously that has implications for how entities participate in the economy. So we don't anticipate a significant uplift from investment activity. And I guess the other one is around the trade account. So export growth, we're not very positive or optimistic around export growth. So I'm just really trying to sort of highlight which sort of items we expect to inform sort of like this 1.3%, which is more or less in line with ours. So we're not really also positive export growth given the constraints around logistics and Transnet and relatively weak global demand. Globally, I think economic activity is expected to slow down 2025 going forward. So I think on balance, the 1.3 and a gradual improvement to 1.6% is realistic given these binding constraints that the South African economy continues to face.
I just want to stay with you, Mamello, here. If we do see interest rates fall in the second half of 2024, could that be a prettier picture than what we're speaking of today?
So I think, so our expectation are for an easing in monetary policy. However, I think, the consumer is still nonetheless under a significant amount of strain. So that moderation in interest rates, starts in the second half of this year through to 2026. We see, interest rates settling around 7%, give or take, in 2026. However, I think consumers that, when we see it in impairment data that's coming out from the banks, that impairments remain quite high. Consumers are struggling. So yes, the reduction will provide some relief, but I don't think it will be significant enough for us to see a notable lift in consumption expenditure.
I must ask you this, Peter, in a private company, any company, a good balance sheet is good for weathering tough economic times. And we know that globally, we are expecting growth to be challenged. South Africa doesn't possibly have, a balance sheet to weather that storm comfortably, as would other emerging markets like maybe India or even China.
So I think this is an interesting question around the growth outlook. I remember originally people for last year around 0.1, we've come out 0.6, 0.7-ish. For this year, we're a bit higher, we're at 1.6, Treasury's at 1.3. And I think we have to be really careful, right? That is the cream on the top of the corporates who do have good balance sheets. They are able to weather these very difficult storms of load shedding and Transnet. But we're seeing a widening of inequality. We're seeing a widening of unemployment, as we saw. So people say, I'm so optimistic at 1.6 this year. But for me, that buys you very, very little, right, in terms of SMME creation, in terms of unemployment, etc. But it does give you a certain amount of tax. We have to remember the tax base is coming through, from this thin layer of corporates on the top of individuals as well. And that's how we're able to manage notionally, economy with huge inequality. We get these sort of weird things coming out. And I think the budget is very much a reflection of that.
Mamello, you also mentioned, I think, infrastructure briefly. I want to touch on this. A solid plan, I think, came through there. The finance minister spoke about a regulatory framework. He spoke of governance. He spoke of addressing inefficiencies, all of it, new financing instruments, all the stuff that sounds really good, I'm sure, to investors. But of course, it's just not that black and white, is it?
Absolutely. And I think the talk around infrastructure is not a new idea that has been proposed in the budget. I think they have labored on it at length. But I think, the projected 900 billion, give or take, to Peter's point, that this, some of the positivity that's coming through, we shouldn't ignore. So we think that, the bulk of that, obviously, according to the budget, will be for investment spending by state-owned entities. And I think if we look at how much investment those entities have made over the past couple of years, it hasn't been significant. And this should improve service delivery and potentially underpin potential growth over time. So I think, we must take the positivity that is coming from the budget speech. And I think, this is one of those, as I highlighted right at the beginning.
Of course, that's a CapEx perspective there, Peter. When we speak about spending, you have mentioned that we're obviously just battling here. And a big thing that came up in terms of reducing expenditure is the public sector wage issue. Of course, there's that agreement from 2023 that obviously needs to be upheld at this point. But what it does tell us at this point also is that we're not able to negotiate that for the long term. And I think it still poses a bit of a risk for all of us. And if there could be slippage, that's where the slippage could come from.
Yes, indeed. I mean, I think we have to remember we are in a 2-year wage bill at the moment. Treasury's held the line, including obviously in the Constitutional Court. They've actually penciled in, I think, a more realistic pathway for public sector wage bills than was in the MTBPS. They were slashing a little bit too much there. So we've actually risen up by about sort of 20 billion or so across the horizon, which I think is as I said, appropriate overall, more realistic, I should say. But there's still these fundamental questions, I think, out there about how you can deal with the public sector wage bill in the long term. It is a risk. It's just not the risk maybe we thought it was, say, 5-6 years ago with strike intensity and things like that.
Maarten, welcome. Thank you so much for being with us today. I think we're just getting overall comments there and really trying to focus on the issue of expenditure and our inability to really bring it under the kinds of control that would bring many comfort. I'm keen to get your thoughts on this one.
Yes, apologies for being late, just Cape Town traffic. But yeah, the expenditure is always a difficult one. Even more so if you're 3 months away from a national election. Then it's not that easy to cut back on things like the wage bill, things like the COVID grants has been extended. That's so important given the social situation of the country. That's something that we can't really afford to cut. So I think there's a couple of things that you can't get away in terms of expenditure. And that's why, the focus really needs to be on getting revenue going. To be able to actually support the important expenses that we need to maintain in any case. One can definitely talk about unnecessary expenses, but I think right now, the wage bill is probably one where we're slightly bigger relative to our peer groups. But instead of just focusing on that all the time to say, well, we need to cut that, rather focus on get the economy going, to increase the tax collection, the efficiency of tax collection, remove the structural issues that are preventing us from creating alternative jobs outside of the public sector. And that would probably get us into a much better position longer term.
I'm glad you touched on revenue, Maarten. I think we're going to go for a quick break. And when we come back, I'd really like to focus on some of those takeouts from the revenue aspect of that bill. We'll be back. We're in conversation with Mamello, Maarten and Peter, and we'll be back after this. Welcome back. Still with us as we dissect Finance Minister Ngwenyana's national budget speech is Mamello Matikinca-Ngwenya, Chief Economist at FNB, Maarten Ackerman, Chief Economist at Citadel, and Peter Attard-Montalto from Crutham. Before the break, I did say that I'd like us to touch on the issue of revenue. Now, of course, we are sitting with this shortfall of around 56 billion rand. But I think what stood out for me is the mentioning of manufacturing and mining as areas that just weren't able to deliver as anticipated. Now, of course, we could focus on issues of Eskom and Transnet, but the truth is that some of these industries have been in decline for much longer than, we've been in crisis mode. And so I'm wondering if that also doesn't speak to real structural declines that would still exist even if we got our logistics and our electricity going. Mamello.
You are correct. I think if we look at the primary sector's contribution and the secondary sector, mining specifically, that has been sort of deteriorating over the past 15 years, give or take. It is linked to energy inefficiencies. And, as we progress through 2023 and going, into 2026, global growth is also expected to be relatively muted. I think that comes through quite strongly in the IMF reports as well as the World Bank reports that, fiscal and monetary support that we've seen over the past couple of years is supposed to be a drag, or is expected rather to be a drag on economic activity. So I think if we take that, relatively weaker global demand, weak commodity prices, our own structural inefficiencies, this is going to weigh on those sectors where, we could collect a significant amount of revenue. And I think the issue around revenue really is also just about, we need to broaden the tax base, I beg your pardon, that those industries are unfortunately in their sunset, and we really need to think deeply about how do we create new industries where we could generate or create a bit more tax revenue.
Peter, I'd also like to bring you in here and maybe even ask you about the issue of the global minimum corporate tax that's coming in. That's on multinationals. I'm wondering how the international community might receive that.
Well, the issue I think has been quite fraught politically, obviously, and has been pushed for a number of reasons by different countries. But I think South Africa has obviously been on a pathway of trying to simplify their corporate tax rates. Over time, we've obviously had the removal of certain allowances, etc., coming through. So, I mean, I think the signalling mechanism here has got a little muddled from Treasury. Maybe let's see. They can tidy it up in some of the presentations they make, for instance, in Parliament tomorrow. But I think there is still a view overall, right, that we are, there are wider issues of competitiveness for the corporate sector, as we discussed earlier, than simply just the tax rate.
Mamello and Maarten, I'm going to ask you to please mute your mics. I think we are getting a little bit of feedback that I think is cool. I think that's much better. I also want to go back to the issue of what we heard of no increase in fuel levy. Now, we know that the fuel price has been a huge driver of inflation here at home. No increase, is that the kind of thing that we need to be hearing at this point, considering road infrastructure and what that fuel levy does go ahead and do? For me, it seemed like a low-hanging fruit and something that nobody can really opt out of if we are strapped for revenue. But of course, we are looking for areas of relief for the consumer, Maarten.
Yes, you're 100% right. I think the fuel levy is definitely a huge income generator for the Treasury. But again, given where we are right now with the consumer under severe stress, high unemployment, high inflation, interest rates where they are at this point in time, I think in an election year, this is something that the government could do to say, well, there's a little bit of relief. We're not going to increase that tax any further. There's other areas that they can look into in terms of making up for that, call it loss of revenue. So I think that was the idea behind that. You're 100% right that, the factor out of our control is what's happening to the world price. That's a global issue. On top of that, you've got the rand. The rand's been under quite a lot of pressure of late. So we end up with a higher fuel price in any case. And then the tax component in the final price that you pay at the pump is actually quite significant compared to our competitors, or not our peer group. So I think that's why at this point they decided to rather skip that one.
And Mamello, you did mention the issue of the GFECRA. I think that's what we're calling it. And I want to speak about this because a big part of it actually does rest on a strong rand. And we know that this is something that we haven't seen in a while, and so much negativity priced into our local currency. I'm just keen to get your thoughts on that dynamic that now will exist between National Treasury, the South African Reserve Bank, and the management of this reserve.
So I think, detail around how they're going to manage that will emerge over the course of coming weeks or so. But I think the point really is that the market has really received that as a positive outcome in the short term, as I highlighted. And really the issue really is those savings that we are making from GFECRA are not necessarily being utilized in areas that, could potentially be growth enhancing.
Yeah, Peter, I think we know from all budgets to take money that is capital in that is capital-like, to use it for expenditure isn't the most prudent way to use money. Often we prefer that money that comes in the form of capex, like the GFECRA, would move on to do something that is growth enhancing, and that wouldn't go to what is like an expenditure. We essentially just consume it. But I'm wondering here if we could see those kinds of terms still emerge as the South African Reserve Bank and National Treasury negotiate how it will work in the future.
Well, this thing is very complicated. It's been going on for a long time. Let's not forget they did this for the first time in 2003 when they put an act before Parliament. They're now amending that act with legislation that they are publishing today. But I think there is broad misunderstanding of this actually from a lot of people who are looking at this. Ultimately this is Treasury's money. It is a liability of the SARB from the SARB to National Treasury. Now there are complexities about how you tap it and how it should work, which is why it is quite hard to understand. It's why they're putting this buffer account in place to ensure the SARB doesn't have negative equity on the back of this. But we need to still remember the fundamental underlying issue here is that the SARB is one that is almost unique globally in building an account like this. Normally, this type of money gets paid out from all global central banks to their treasuries every single year because it accumulates to ultimately to equity and not to liabilities. So we're just sort of trying to fudge in some sense, given the law and various things in the SARB Act, a conversion to what is a global norm. So I think people overplay the concerns here. There is going to be a publication of much more detail about the agreement, and I think you'll make it very clear there the conditions and that this can't be used for everyday spending. It's used to lower debt service costs. And what we've seen in the budget is that Treasury is happy to use some of those debt service cost savings, not the actual Jafetra money, to be able to loosen some of those spending at the margins, but not a ginormous amount.
I'm actually glad you mentioned the issue of debt servicing costs. Throughout the African continent post-COVID-19, we've seen many countries coming out in some sort of debt distress. Can I say with confidence that South Africa isn't anywhere near there as of today? Maarten?
Yes, I think we're not out of the woods yet, but if you look at the budget and if you look at the plans to execute on this budget, that is definitely something that we can avoid. You know, the interest payment is around about 20% of the budget, 20 cents in the rand, if you like. If we didn't follow this route of tapping into the gold reserves, you know, that number could have increased to, I don't know, 25%. And then the risk starts to build. You know, when your interest payment gets more than a third of your total budget, there is then a risk that you can default and have serious issues. So I think, like you said, where we are right now, with the budget today on the table and the plans going forward, we'd probably avoid that.
Mamello, are we looking at being more conservative here with our debt? Could we be doing more for that part, or is this just where we are right now and something that can only be managed prospectively?
So I'm going to ask you to repeat that.
I'm asking about the continued management of our debt and the stability of it. I'm also keen to get your thoughts here for where we are in terms of being in the woods.
So I think today's budget does quite a bit just in terms of lowering that peak in our debt to GDP ratio. And the MTBPS, I think it was around 77%, give or take. It is now at 75% give or take of GDP. So I think in the short term, it does assist us in terms, I mean, as you would put it, getting us out of the woods. However, I think, you know, the point really that I've been trying to emphasize is that, you know, in my view, this is not necessarily a growth enhancing budget. It ultimately sort of just delays the inevitable, just, you know, kicking the proverbial can down the road. And at some point, this will catch up with us. So in the short term, great, just in terms of debt management. But I am concerned that over the longer term, you know, this is going to come back and haunt us again.
And what could that look like, Mamello, when, you know, we do see some of those chickens coming home to roost?
I think if we sort of just see that persistent deterioration in our debt to GDP, there's a lot of countries that we can draw, I guess, information from that have gone through a similar issue in the continent. So I think eventually we sort of just find ourselves with being downgraded further, the economy not growing at the rate that is required to stabilize that debt, and potentially maybe looking at other measures. It could be financial repression. I don't know. We'd have to be creative over time around how we deal with it. Or it could be seeking assistance at the IMF. Well, I'm not saying that this is going to happen over the next 3 to 5 years, but what I'm saying is this, what is in the budget today buys a bit of time, but it doesn't necessarily deal with what is required for us to, I guess, sustainably turn the ship around.
And Peter, your thoughts on this debt issue?
So I don't think we're that far from the fiscal cliff edge still. I mean, maybe we've now turned the car around and pointing in the opposite direction, but we still have these risks, these narrow tax bases that have been mentioned, the fact that cabinet is still not making these fundamental policy choices, and you get these parcel down salami cuts, as we call them, to provincial and municipal level. So there are deep, suboptimal things going on within the budget. And we shouldn't forget as well, there's an awful lot of issuance still in this framework, even with Trifecta. A lot of, even though they've cut SAGB issuance back very slightly, they're issuing a lot of other round paper into the market. So there's still a little bit of that sort of crowding out going on around the edges. So no, we're not flying off the fiscal cliff edge maybe that we thought there was a risk in COVID times. But I think we need to still understand that this thing isn't entirely where it should be.
We do have to go for another ad break. Please do stay with us for more insightful post-budget analysis. We're back and continue unpacking Finance Minister Ngwenya''s national budget with Mamello Matikinca-Ngwenya, Chief Economist at FNB, Maarten Ackerman, the Chief Economist at Citadel, and Peter Attard-Montalto from Crutham. I'd like to get your thoughts on SOEs. It sounds like they were snubbed. A lot of them actually snubbed. All we heard, I think, of was that 47 billion rand guarantee that was made for Transnet, which of course we spoke about earlier, and that was from the MTBPS. And then nothing else. We don't often hear this little about SOEs in our budgets. Hey, Mamello.
Yes, I guess a high five to Peter for calling it in the preview around Transnet. But I think, one shouldn't forget that there is still support in the system for Eskom in the background. So that's quite important. So I think it is quite pleasing that government hasn't overexerted itself just in terms of the support that they have granted to state-owned entities. And I guess, again, it really speaks to sort of these trade-offs, coming into this budget. There is an understanding that Transnet is quite important, and I think they do labor on that point quite a bit in the budget speech. And perhaps it's some of the reforms that need to happen in the background before you do allocate a bit more money to get that entity going again. So this idea of, private sector participation, I think that was highlighted in the budget. So I think the third party access and, improving some of the inefficiencies to get the entity operating efficiently. So I guess it's quite good that they have taken that posture in this budget and not necessarily doing the same old thing of, making provisions for the SOEs. I guess that is a good or positive in the budget.
Yeah, Peter, this finance minister specifically, Ngwenya, has been very, very, strict, and I will use the word strict with SOEs. And I think it's very, very impressive to see him sticking to his guns. But of course, a lot of these SOEs are in ICU. There's still a huge expense to, all of us as taxpayers and the fiscus at large. Something still needs to be done about them.
Yes, and I think, it's not a new thing for Treasury. They changed and started to change the guarantee framework in a cabinet memo, I think it's from the end of 2021, which started to tighten provisions of guarantees, for instance, and put in place a conditionality. So it's not entirely new, but I think we're very much seeing the playing out of this playbook now, this tougher playbook, as you say. The problem fundamentally, of course, is the reforms aren't all ready to pick up the pieces, and we shouldn't actually forget that reforms also create problems. So reforms of sucking additional generation, marginal generation capacity out of Eskom will create a bad bank stranded asset problem for Eskom will have to deal with. It's the same with Transnet, as we see obviously better private sector provisioning of third-party rail access and port concessioning. There will be this sort of rump end left behind. So there is a sort of looming longer-term SOE problem that's sort of beyond the forecast framework, somewhat that we shouldn't forget about. But no, I think the most important thing here is Treasury is holding the line, and this tough line, particularly on conditionalities.
Maarten, any thoughts on the issue of SOEs that have, like I said, traditionally been a huge part of our national budgets?
Yeah, I think I agree that, the discipline to not just repeat the Eskom movie is encouraging, especially with Transnet that's now second in line. Those are obviously the two big ones that we talk about on a daily basis, but there's, how many SOEs that, like you said earlier on, is still taking taxpayers' money and they really don't add to the economy. Think about the post office as an example. So what we did learn from the Eskom experience is that you can't just keep on throwing money at the problem if there's no real accountability to turn those enterprises around. Just think about the tax break announced in last year's budget for business in terms of solar installation, and how much that improved a lot of the private business in terms of the ability to operate under load shedding. So a step like that is much more encouraging than just providing further lifelines to these SOEs. I guess the problem is that many of the SOEs are also co-responsible for the huge wage bill we're sitting with, and that's a challenge that the government is facing. It is to make sure that you can still make a case for them to exist, but if they can't turn around and operate like a normal business in the economy, you can't just keep on providing bailouts from the fiscus.
I'm also keen, I think that segues perfectly into the issue of municipalities. Of course, there'd be, a revenue that is apportioned to them, and that's exactly how it should work, because that's where the service delivery back stops. But I'm keen to get your thoughts on this one specifically. He mentioned issues of climate finance and, climate interventions that sit with the municipalities. But also, I think what we're seeing just in terms of the relationship between National Treasury and the municipalities, the huge inefficiencies that then trickle down. And most importantly, the Eskom, relief program there that is supposed to be for the municipalities, a lot of them not qualifying to participate because of just how tough those municipal finances are going. I'm wondering if this was the platform for us to possibly spend some more time speaking about that, how things do move from National Treasury up until, you and I in our local municipalities, Peter.
Well, I think this is the fundamental problem, right, between macro and micro fiscal. So the clawing back of, housing grants from Tshwane and other metros, right, is positive from a macro fiscal sense. The falling over of municipalities is positive because Treasury claws stuff back, right? But this just has a deep micro inefficiency, and we're not seeing the tail or the other side of the coin, if you like, in terms of actually improving processes on these sorts of things. And so we have this deep inconsistency here between the micro and macro fiscal, which I think is quite worrying. It ultimately will play out, I think, in terms of obviously election issues and potentially, though not to be too alarmist, in terms of social stability issues as well in the long term. So we need to think very carefully about this. A lot of the Operation Vulindlela reforms, for instance, which are progressing really well, are all macro issues, right? They're not down at the municipality level. Water is the key example where they're doing great things on macro, sort of countrywide water, but not on municipal water. So no, I think this is the sort of hidden problem behind the budget that we see today, and we need to see others in government. And Treasury has a tough time, right? Others in government don't pick up this baton and run with it. There's very little they can do.
Mamello, another risk that we will possibly face in the future?
Absolutely. I think, ultimately, your municipalities are quite important just in terms of ensuring that we do get good service delivery. And I think another key thing is over time, and I think there has been a bill of legislation that really speaks to ensuring that there's qualified people that are hired within municipalities to be able to execute some of these duties. And I think, firmness around that is quite important. And also just making sure that, that these municipalities also get clean audits is also quite critical over time. So I think if we don't fix for that, it's quite difficult for me to see to the point how the macro policy then becomes implemented at a micro level if we haven't dealt with those issues.
I want to touch on NHI. I think, Peter, you called it in our pre-analysis that it hardly gets a mention. But, the minister said a few interesting things that made me think that maybe they are understanding of the fact that the NHI in its current form isn't ticking the right boxes. He said certain activities are needed to still, take place there, from digital patient records to strengthening facilities. Very, very clear here that no money is being funneled in that direction at this point. But speaking about it like it is something that is inevitable, Maarten.
Yes, yeah, that's one of the ANC's deliverables, one of the pledges they took 5 years ago in terms of what needs to be delivered under this term. So it will stay part of the agenda. It is encouraging to see that when you get to the gridlock or the details in terms of how do you fund that, do we have the logistical systems in place to actually run something like that, that those kind of things will still override the final decision. But despite the fact that, socially we need to do that for this country, the fact that we need to overcome these hurdles, and it might not happen this year or even next year, I think the talk will continue, because it is a promise to the people that in time there is hope that you will have better healthcare in this country.
And Peter, on this one, I think you would have mentioned earlier, there is no philosophical debate about the necessity of this issue, but it just needs more ruminating and more application from our side.
Well, no, I think the current NHI said bill needs to be completely ripped up and started again. I mean, I think that there are such deep problems within it. But no, it was sort of amusing. The document indeed didn't say anything much at all on the budget review document on NHI. The speech had a short paragraph on it. But if you think about this total cost of whatever, there were the ranges, as you said, I think in the preview before, so 300 to 500 billion per year. They're saying they're spending 1.4 billion, right? This is like absolutely nothing. This is not NHI. This is stuff that they are doing anyway around digitalization and patient records, things like that, which they are giving an NHI label, I think, just for cover. So no, I mean, I don't think you can call 1.4 billion that was already there, from and this sort of spending has been there for a while. That is not NHI.
Well, I'd like us to go on a quick ad break, and on the other side of this, we'll wrap up our post-budget analysis. Stay watching. Welcome back. Still with me as we wrap up with a post-budget analysis is Mamello Matikinca-Ngwenya, Chief Economist at FNB, Maarten Ackerman, Chief Economist at Citadel, and Peter Attard-Montalto from Crutham. I'd like to get your thoughts on the issue of new energy vehicles, or EVs. We know that the industry has been lobbying government for a while for some sort of incentive that would incentivize you and I to look at EVs. We know they're expensive to produce and actually just not something that is affordable. But we've seen that in developed nations like Germany, for instance, they've pulled back on those incentives because the fiscus just cannot afford that pressure. And we didn't see anything of the sort being announced today, even though there are some incentives that I think will kick in 2026. I'm wondering if this compromises the sector and the future investment that we're trying to get out of it. It is one of the few places of real new industrialization here in South Africa, Mamello.
Sure. So I think the motor industry has really been calling for a lot of intervention in this sector. And ultimately, I think to remain competitive, the world is moving in the direction of greener energy. So I take it as a positive that there is some thinking around it post the papers, the green paper, and I think the white paper that followed post that the government is taking this conversation quite seriously, and it is trying to incentivize that level of investment into the automotive sector.
And Maarten, would this be enough? I think many of the big players have asked for more than what we're hearing at this point.
Yeah, well, I think this is a starting point. What's very important is that the motor industry in South Africa is a huge industry. It's a massive job creator. And in its current form, if we're not going to talk about this and provide incentives to especially also attract further investments from the mother companies, which are all non-SA, then that is a dying industry in terms of the manufacturing base. So it is so important that our government play ball with these companies to make sure that there are incentives, because they do have the option to go and produce somewhere else if there's better alternatives. And that will come at a cost. And remember, we're not producing here necessarily for our market. I think our market is still way behind the curve in terms of adopting EV altogether, because it's not just about having an affordable EV vehicle. It is about being able to charge that vehicle and get around in the rural areas, which we are years away from. But it is to be able to be a global player in terms of manufacturing, which we are at this point in time. But as this industry is changing, we need to make sure that the incentives are in place.
Peter, I'd like to speak about the social protection, what we saw there with the grants. In my mind, it was hardly any increase. I think one of the grants is going to increase by 20 Rand, and I can't imagine how much that would make a difference, or how that would make a difference. But what we saw is that SRD staying flat at the 350 Rand, no inflationary adjustment, and that also just tells us that government is trying, I think, just in terms of managing expectations about that, and also the issue of the basic income grant is definitely put on the back burner.
So the grants thing was a little bit of a surprise, because remember, the DA has thrown down the gauntlet quite a bit now in terms of talking about larger increases in grants that they would want to bring forward. That was in their manifesto. We thought that the budget would, and there was space in the budget to offer a little bit more actually, than has actually happened on non-SRD, to be clear. So a little bit of a surprise here. The SRD, less of a surprise. There is still no resolution between DSD and National Treasury and the Presidency on what on earth SRD is. Remember, it's a random level. It's not linked to food poverty lines or anything. And there's no agreement on the transition of SRD into a basic income grant or anything else yet. So I think less of a surprise that there wasn't resolution on that. We saw no, obviously, announcement in Stona on a basic income grant either. So I think there is a sort of storing up of some political risk around grants after the election, potentially, where things may need to move. Either an opposition party coming in promising more, or the ANC feeling and under pressure, say, before the next local elections to offer a little bit more. So it feels like a little bit of a hole in the medium run.
Yeah, I'm keen to get your thoughts also on that one, Mamello. You know, often, for instance, when the SRD was initially introduced, we had the likes of ShopRite, for instance, coming out to see that they had seen that there'd been some sort of stimulus in the economy trickling down into their revenue line, and of course that eventually being some form of revenue for government. And I'm wondering also if this was an opportunity to also just boost household expenditure.
Yeah, so I think the point for me really is that you've got competing priorities. So so government in this instance, chose to increase wages for police force, teachers, and so on. So they have to sort of balance these competing priorities. One, yes, would have thought that at the bare minimum, maybe there would have been inflation adjustments, give or take, but I really take it as a positive in the context of, how do you, you don't have enough to be able to appease everybody. And in this instance, we are seeing that government is spending. We're not seeing expenditure coming down, and they have decided that the place for them to allocate it is in wages and a little less on the social grant. A surprise, but in the context of the limited resources that they have, I guess, is a positive.
Then I also want to touch on the issue of taxes. It was also quite mute, I think, on taxes. Often we would hear of relief for taxpayers. Of course, that was off the cards, and I think we might all understand where that rationale, where that could come from. But I'm also keen just to get your thoughts on the issue of South Africa's shrinking middle class and the increasing of the tax base here, which I think is also an emergency waiting to happen over the next few years. It might lead to something a little bit more critical than what we're seeing now, considering how the middle class does subsidize other, people within the economy. What are we hoping we can do with just tax revenue collections from ordinary individuals to boost the fiscus, but also just to keep it reasonable for the ordinary South African, Peter?
Sorry, that's me. So the issue, I think, really for ordinary South Africans is going to be the space ultimately to deal with some underlying problems, right? Over the employment, most of all, that's going to come more from the structural reforms that are happening. It's going to come from particularly interventions in lowering labour market barriers to entry and proper transport reform. which I think we often gloss over when we think about freight logistics, right? The importance of labour market barriers to entry is exceptionally important. But it's also dealing with this issue we brought up earlier on municipalities actually being able to do service delivery at a local level to keep local businesses going, where the vast majority of people ultimately are employed. And again, these are all things that are sort of outside Treasury's purview, is why I'm always slightly cautious that people read a little too much into the budget, saying various things on other parts of government doing things. It's a long road to go on many of these things. I think this was the disappointment in SONA, right? SONA didn't really lay out for us this forward-looking second-term agenda at all. The only thing it mentioned on second term was early childhood development, as much as that's an important issue. There are a lot of these other nitty-gritty issues that we will be waiting for the second SONA in June, July to tell us more about.
Maarten, I want to bring you in here. We've spoken about increasing that tax base. Very little and nothing, I think, on SMMEs. Even in the SONA, mute on SMMEs. This is where the jobs would come from. This is where growth would come from. Are we not thinking about SMMEs? Should there have been something that speaks of supporting small businesses in this budget?
The growth engine of this economy is really going to be those small, medium enterprises. We know the ease of doing business in the country is not where it should be. This is one of the points that the president is also well aware of. So, you can reduce tax, and that will be taken as a positive, but will that really enable them to ease doing business? So now you start talking about, are there other issues that we are struggling with on a daily basis? We know them: electricity, logistical network, ports, dealing with the masters in the different offices, registering, paying tax, VAT. So it is not just providing a tax break. That's almost equal to providing a bailout to an SOE. That doesn't fix the problem. So I think, there's a lot of other things that we need to address outside of the budget to make it easier for these kind of businesses to operate, and then automatically to start creating more jobs, broaden the tax base, and support the middle income class that you referred to on earlier.
We're nearly out of time, Mamello. I think I will go with you the last question here. We do have that election on the 29th of May with this budget that has been tabled. I think from an investor perspective, we can expect this to at least weather the election storm, and whatever we see on the other side of the 29th of May, this should hold, right?
I think, again, it's positive in the short term. It doesn't necessarily deal with how do we create jobs, how do we strive to get even close to the targets that the NDP has put forward for 2030 from a labour point of view, from an investment point of view, and outside of the NDP, sort of where we fare relative to our peers. So I think it still lacks from that perspective. I'm not 100% convinced that it will ease sort of the frustration that South Africans feel and how they will sort of participate on the 29th. But we shouldn't take away from the fact that it was a decent budget. However, I'm not really sure whether it's going to have a significant bearing on the outcome of the 29th. Just the market for now may perceive it as positive.
Well, that's all we have time for. I'd like to thank you all for your time this afternoon. It's been an absolute pleasure engaging you. And also thank you for peeling through this with us. That was Mamello Matikinca-Ngwenya, Chief Economist at FNB, Maarten Ackerman, Chief Economist at Citadel, and Peter Attard-Montalto from Crutham. On the other side of this, we continue our rolling coverage of the national budget with business veterans Bonang Mohale, Mike Brown, and Kaz Kuvadia. Stay watching.